And, well, we've seen this precipitous slide in stocks around the world. It's continuing again today, and investors are looking to other strategies to try to protect their income and preserve their wealth. Casey Weade is going to join us now, Vice President of Investment Management and Financial Planning at Howard Bailey Financial. He is live from New York. Casey, good to have you on the program.
Excited to be here.
Good stuff. We need some ideas, I think, because many of us have, I wouldn't say a simplistic, but a rather basic approach to markets. We're in when they're up and we try to come out when they're down, but that's not always the right strategy, is it?
Yeah, I think people have gotten very used to the old strategy of buy and hold. Buy and hold's dead. You know, we had the 80s and the 90s with consistent growth in the markets. Now we're seeing much more of a roller coaster ride, a lot of negative activity, a lot of negative economic activity. The fundamentals are poor. Greek debt crisis, U.S. debt ceiling, Japan's earthquake, disrupted supply lines. We've just got a lot of rough economic times ahead of us, and so we need to have a little bit more of an active strategy.
We were looking at a report earlier in the week, Casey, from Credit Suisse, which was very bullish on global equities and U.S. equities as well. But I see in your notes that you've actually rotated quite a portion out of the equity market into the parking lot of treasuries. What are you most concerned about?
We have. I think we're most concerned with protecting our clients' wealth, protecting their capital. And with economic data that has been coming out, we're just not seeing a lot of consistency. We're a little concerned with what's been going on in the market, and I think rightfully so. We've seen 6 consecutive down weeks in the market, and I think our move to treasuries 3 or 4 weeks ago was a good move for us, good move for our clients. It protected their capital, and we made a little money in the meantime.
Yeah, there's been a good rally. You chose to do it through Treasury ETFs, Casey. That's interesting to me. Tell me about that, and which ones did you choose?
We did. We used Treasury ETFs because we are making much more active moves. We use what's called a dynamic strategy for our portfolios. You know, during the good times in the 80s and 90s, when positive economic indicators are looking good, fundamentals are good, well, we might build a more portfolio that's a little more consistent, and we aren't going to make as many trades. Now we've got a little bit more of an active strategy because we're looking at more of a roller coaster ride, and we need to have more consistency. We're using ETFs because the market is moving very quickly, and we're going to be making more moves, and we want to get out of those positions if something does occur in the market that forces us to. Let's say we come to a conclusion in the U.S. debt crisis or the U.S. debt ceiling that we're not considered that's going to impact treasuries negatively, then we can make a move a little bit quicker than we could with mutual funds.
That's the thing, isn't it, Casey? That the strategy you just described has 2 significant wild cards in it if you're going to find favor in treasuries. Not only do we have the debt ceiling issue, which is looming, but also we had today that significant acceleration in consumer prices. Both, one would think, are bearish to the strategy that you're looking at right now.
Correct. Yeah, absolutely. We've got inflation numbers coming out, and we would have thought that would normally hurt treasuries, hurt bond prices. But as we can see, it did not, because it was, it came out at the same time with some poor economic news, and there's not a whole lot of positivity out of there. So where are investors out there going to go today? They're going to go to still one of the strongest economies in the world, that being the U.S.
You're seeking returns of between 4 and 6% annually, and as you say, the responsibility of wealth preservation is paramount given your clientele. Casey, what are you going to look for in the second half of the year if you are going to get some cash back into equities? What signs do you need to move the money there to reach the annual returns that you're targeting?
We need signs across the board. We don't need the markets currently trading on daily economic news. One day it's good, one day it's bad, and it's very volatile. Well, we need to see something across the board. So we're seeing housing prices are paramount. We also have unemployment numbers. And 2 of the most important issues we need to come to a conclusion on, so investors have a little more consistency and can look forward, are the U.S. debt ceiling. We need a conclusion there, as well as a little more consistency with what's going on in the IMF and the European Union.
Do you need something clear from the Fed statement either next week or at the expiration of QE2 as well?
Absolutely.
Yeah, what are you expecting?
We need to... Well, I don't know what to expect. I think we're going to see a lot maybe over the next several weeks. Obama's going golfing this weekend, and supposedly he's going to come to a conclusion over this time. We'll see what's happened, and then we'll make our move. I think we're going to sit on the sidelines until we see something definitive. We can't make a move now, and I don't think anybody out there truly knows what's going to happen. And so we just got to keep a good eye on everything.
Yeah, including the golf course. Casey, we're really grateful for your time this afternoon. Thanks for joining us.
Thanks for having me.
You're more
really
than
appreciate
welcome.
it.
Casey Weade is Vice President of Investment Management and Financial Planning at Howard Bailey Financial. He joined us live from New York. A lot of very sound decision-making along the side.